Hey, welcome all. This is Mindful Finance and here I am Sundar. So this week we are going to discuss about index. What is index? So in my previous video also I concluded with index would be the best options to go ahead with. My friends and close circle came up to me and asked what is this index means. This discussion is mainly for people who are not aware of what is meant by index and what is index fund is all about. If you are new to this one and if you want to understand what is this index, end of this video you will get a complete clarity about what is index fund, what is ETF and what is passive fund. So let's get into that. What is an index? An index in the context of finance and investing is a statistical measure that represents the performance of value of a group of securities or assets. It is designed to track the overall performance of a specific market, sector or an assets. So in a simple terminology, if I say index is a representation of a group of stocks or assets, for the market perspective, this will be considered as a benchmark. So that is how the index is defined. Our market, India, has a couple of indexes, which is the major one is Nifty. So that is what I'm going to cover over here. So Nifty 50 is the major one, which is the premier stock market index in India, and this represents the top 50 companies listed in the National Stock Exchange. The 50 stocks selected in the based on certain criteria, which are like market caps, liquidity, and few more criteria. The Nifty 50 index investing. What is index investing? This can be done in two ways. One is through ETF and one is through mutual funds. Mutual funds already people would have aware of that, and I have covered in a couple of my videos also, but just to give a quick summary about that, mutual fund is something that a manager, a portfolio manager sits and manage your investment. For an example, as a retail investors, we invest money and we give the money to the portfolio manager. Portfolio managers are the one who handle our or manage our investments. So what mutual fund managers does, they get the money from you and they invest in stock market. How they does that? They make a basket of stocks. This basket of stocks could be in different sectors and they give a name to their product. It could be a sector based, a theme based, or the market cap based. It's so many ways they does that. The fund names could be hybrid fund, liquid fund, sector fund, whatever it is. I can give you some couple of example. If you take SBI, there's a small cap fund. So they invest in small cap index. Hybrid fund. Hybrid is something that mix of large cap, medium cap, all those kind of things are mixed together. A small portion will be invested in debt instruments. So that is how your money is being handled by mutual fund managers. Now what is this ETF? The same thing what ETF does is, ETF is purely based on index. This is a replication of the Nifty 50. I'll show some example or I'll demonstrate in the next step. So as I mentioned, your portfolio could be the mutual fund could be a theme based, a sector based or your goal based. So there are different types of mutual funds available in the market. But ETF is something that always represent index. It could be your Nifty 50, it could be your Bank Nifty. So before that, there are a couple of or more indexes available in our market. But in a high level, we have only two, we can say, which is Nifty 50 and Bank Nifty. Apart from that, you can go with the IT index, Pharma index, Metal index, FMCG index. So we have index specific to sectors also. So, but in an overall diversified way, we can say Nifty 50 is something that has a 50 different companies and in a diversified way, and those 50 are top 50 companies in our India. So ETF is something that it exactly replicates what Nifty 50 does. So maybe it might be a little bit complex. For that, I'll just try to walk you through what is this all about and how this Nifty 50 is comprised of. So let me show you this example. So what I currently have is, this is something that I pulled out from the NSE website. These are the top 50 companies. You can see starting from Reliance, the last one is UPL. These are top 50 companies. If you check the sectors, you can see energy, financials, information technology, you have different set of sectors also. So what it does is, it captures top 50 companies based on the market cap. In that, if you see, Reliance is the topmost company which has the largest market cap in our index. So what happens is, the weightage is given as 10.5%. What does that mean? If you say 50 stocks, the 100% category, Reliance alone contributes 10.5%. If Reliance moves in the market by say certain percentage, so this is the heavyweight. So this can move your entire Nifty 50 market because it has the heaviest one. The second one is the HDFC Bank, which has 8.8%. Third one is ICICI Bank. So similarly, you can see the percentage of allocations. If you invest say 1 lakh, what happens is this 1 lakh is based on the weightage. The money will be invested in the stock. For example, within 10% of your 1 lakh is say 10,500. With that, I can buy 4 stocks. So this is the current market value. This is the current price of the stocks. So with this money, you can buy 4 stocks of Reliance, 5 of HDFC Bank, 8 of ICICI Bank. So that way, your 1 lakh is planned in such a way that it covers all the 50 stocks. You can go over here, you can see that. This Excel sheet, the link I will provide in the description, you can download, and you can also track your portfolio and your weightage and all those things. You can compare with this one. So basically what I'm trying to say is, you can see the number of stocks you can buy with the 1 lakh rupee. If you see few things are in zero, that means with this money you cannot buy certain stocks. So what happens is, you need at least 11 lakh 50,000 rupees to buy all stocks in the recommended percentage. You can see, right? For Reliance, you have to buy 48 stocks. HDFC, you have to buy. If you want to replicate the exact stock market Nifty 50 index, you need to invest this much. So that is the replication of Nifty 50. If you want to invest directly in the stock market, you have to buy or invest this much of amount and buy this much of stocks. So that is what Nifty 50 index fund or ETF helps you in solving the problem. How it happens? You don't need to invest lakhs. You just invest 1,000 rupees. In 1,000 rupees, you cannot buy any stock. But if you see here, the mutual fund column, I can buy 0.042 quantity of Reliance. So that is the power of mutual fund and ETF. So it helps you to invest in all the sectors and all the stocks in a balanced or in the required composition. You don't need to buy the complete one stock or two stock. You can even buy the fractions of stock, 0.042. So that is how you'll end up, and you can own all the stocks. So that way you can start investing in smaller quantities. You can start to invest with a minimal amount, and you can start owning the stocks. So that's how ETF and mutual fund works. Now go back to our slide. So that is what it is index investing means. If you are investing in index, that means you are replicating or you are copying the index behavior. That is what this is about. And when you are investing in an index fund, that means your portfolio is diversified. What is meant by diversification? For example, our market is volatile. That means each and every industry has a cyclic pattern. This year, IT sector may do well. The next year, IT sector may go sideways, or it can go downwards also. Similar way, pharma industry can do better, or metal industry can do better, or automobile industry can do better. So it's like a cyclic. So each has its own time period. All stocks or all sectors will not perform the same way every time. Each one has like a season. We have 4 seasons, right? Similarly, this stocks also has its own way of performing. So that is what this 50 stock exposure is towards diversification. What are the benefits of investing in Nifty 50? You are going to invest in not single stock. You are going to invest in a very broader market. Basically, you are investing in 50 largest companies in India, and you are investing companies which are actually representing our Indian market. And your portfolio is diversified with the different sectors. So that is the power of Nifty 50. Whatever the investments you are doing in the Nifty 50, it has a stability and consistency. As I mentioned earlier also, you are not just investing in one specific industry. There are different industries, IT industry, pharma industry, metal, so many. Your investment is completely diversified. Even though the market is volatile, some or other industry performs better at one point of time. Always think in this way. If this year IT is not performing well, at same time automobile may do good. Similarly, next year if automobile is not doing good, your metal may do good better, or your FMCG may do a better job. During the inflation time, if you can see always FMCG may do better thing because they have the pricing power. So that way they will do better job. So this is something like related to macroeconomics, but let's leave it aside. In a nutshell, if you see, Nifty 50 is, since it is diversified, your portfolio gives stable and consistent return. I'll just show you the statistical data of our Nifty performance in the past year. So this is the Nifty index return. I'll just demonstrate to you how our Nifty has performed in the past 24 years from 1999 to 2022. If you see, these are the returns. You can see. So it's not uniform, but ups and downs are there. You can see in the visualization, the chart, how the performance over here. But in an average, if you see, it has given 17% returns, which is awesome. So I'll just show you, I'll just demonstrate if you have invested 1 lakh every year, how much it would, what is the current value would be. Let's use our formula to find the future value. If you want to understand how to do this future value calculation, please look at please go and watch this video. There will be a link given over here. So future value formula is, what is the rate of interest, which is 17%. And what is the NPER? I'm going to invest for 24 years. What is my payment, which is minus 1 lakh. What is my present value, which is 0, and what is my at the end of the period I will be getting this money. So if you would have invested 1 lakh every year and your portfolio is currently 2 crore 57 lakhs, just imagine. So that is the power of compounding. So this is something like crazy, right? No, you can't even imagine this level of growth in your investment. I'll show another example of another index. So this is IT index. So I pulled the data from IT from since 1999 to 2022. If you see the chart also, it looks like ups and downs, and sometimes it has gone up, sometimes it has given a negative returns, but in an overall it has given an average 27%. This is crazy amount of rate of return. Same like index fund, we'll do a calculation for our IT. So what is the rate of return, which is 27%? What is the number of years I'm going to invest? 24. And how much I'm going to invest is minus 1 lakh. And what is my present value, which is 0, and I'm going to get at the end of the period. You will be getting 11 crore 83 lakhs. If you have invested in IT index, this is your return. So that is the power of index. You don't need to go and pick anything. So that is the power of index investment. And another thing is the transparency. You don't need to worry about what the portfolio manager is doing with your investment, because it's straightforward. They are just going to replicate what index does. The index is set by NSE. So portfolio manager doesn't have to put more amount of effort to diversify your portfolio or plan what to do with your money. The next is expense ratio. Since your portfolio manager is not putting so much of effort, the expense ratio amount, if you go to a mutual fund or ETF, you'll find an amount mentioned against expense ratio, which could be around 0.1%, 0.2%. It can go maximum of 0.3 or 0.4%, but it should not go beyond 0.4%, which is crazy because it's just duplication of your index. There is nothing much has to done by your portfolio manager. That is why this is called as passive fund. You just invest. You don't think much about that. It's very, very straightforward. You don't need to worry about which stock to pick. You don't need to go and check their annualized annual performance or quarter result, nothing. You just blindly invest on those 50 stocks based on the weightage. So that is the advantage of Nifty investment. And it also, Warren Buffett also given in his one of his quote that nobody can beat index. So that way, whatever the active funds the fund managers are handling it can never able to beat index. We have very good portfolio managers in our India, but still it's very tough job. And if you also, sometimes what happens is you may get more returns, but your expense ratio might be more. So that way you have to compensate, and end of the day, if you compare, it won't be more than your index. So currently the scenario is people are getting more and more aware of this investment in index fund, and people are started to invest in different index funds, index mutual funds, or index ETF. So based on this, the record says that amount of asset under management is keep on increasing. If you see from 2009, you can see the how much money is being floated around in the market. So that is the growth we are facing. But still, in an average, our whole Indian economy or Indian population, right? If you compare, it seems that only 3 to 4% of our people is investing directly in the market. So just imagine, from the 100% of population, only 3 or 4% of people only investing in market means if this increases in the future, so our market, just imagine where it can go. So since after COVID, people started to realize investment is very, very much important, and retailers also understood that market returns are far better than other FD and other returns. Now hope you understood what is this index is about, and what is this index fund is all about, what is portfolio, what does the portfolio manager does, and how can you mirror the investment based on your Nifty. So all those things you would have understood now. So the simple thing is, do thorough research and try to understand simple thing is, You don't need to put a lot of effort. Do things mindfully. Understand how this works. You don't need to go and watch your market every day. Very simple way, in a disciplined way, and in mindful way. If you start investing, even the very minimal amount of 1,000 rupees, if you start to invest, you can understand the power of compounding, and in the longer run, your money will start to multiply. So understand the basic how the market works. If you are able to understand the basics, nuances of how the things works in investment, then you can sit and relax, and your money will work for you. Thanks for watching, and please do share your comments if you want to listen to any other interesting topic in the future. I'll work for that, and I'll provide a detailed analysis on this thing. Thank you.